Great. Well, thank you. Welcome, everybody. J.Thelander live from New York right now. And hi, Allie.
Hello.
We are going to have our 30-minute lunch and learn today, or comp talks on the Equity 101. And we are looking forward to having hearing from you in the audience. If you would send along questions as we're going through this, because we will try and address your questions and keep it interactive versus a canned presentation. I'm going to get right into it because I know we only have 30 minutes and it seems to go really fast. So I'm going to turn it over to you, Allie, and just to let us know what you're up to over at Cooley and sort of your take on what's happening right now in the private markets.
Sure. And I'm Ali Murata, a partner in the compensation and benefits practice group at Cooley. I've been practicing about 25 years, and I feel like, we're usually on the way up, on the way down. It's always a fun ride. But, for now, it feels like much of the same as we've been seeing historically, although I think on the tech side of things, we're seeing valuations start to increase, feeling like it's on the way back up. And activity, of course, on the life sciences front is still talking about option repricings, things of that nature. I'm sure we'll get into some grant practices in a minute, but looking forward to our session.
Great. Well, I'm going to jump right into some data because I think it's always an easy starting point. So I'm going to share this and I'm going to make my screen bigger here. There we go. Perfect. So the data that you're going to use today for our discussion all comes from Thelander, which is we're a compensation intelligence firm, and we have data across the private markets, both for private companies as well as investment firms. It's real time, and we get our data directly from the companies through our surveys. And we have a great relationship with Allie and Cooley because we get a lot of expertise around what the questions we should be asking to keep the information as relevant as possible. We also have a great podcast. Allie's been on that too. So we hope you subscribe and listen to it. It's really fun. I do that with Morgan, my daughter. As far as industries and what we cover, which I think is really relevant today because there's so much crossover, we cover both the life sciences as well as tech. And I know that our audience today is a mix of that as well. So that can include fintech, biotech, medical device, consumer, gaming. I mean, really the gamut. And I mean, Ali, from your perspective, are you seeing a lot of difference in terms of the deals that you're doing and what's happening across life sciences and tech? Maybe give us your perspective on that, especially as it relates to equity and M&A and liquidity.
Yeah, so I think that certainly for um, technology companies, I'll start there because it feels like not much has changed from the perspective of, companies still facing a fairly long road to IPO, liquidity, exit, M&A, whatever your end game is there. That time horizon is longer. On the life sciences side, a little bit of it feels like dual track, more of those, dual track transactions, reverse mergers. So more alternative ways for companies to become public companies than just straight IPOs.
I mean, on the IPO market, even what we're seeing here, life science companies historically took longer, and now tech is taking longer too. And revenue is really not a big component of what is going on, right? Because most companies are not having revenue. And and valuations are really fluctuating, and the impact of the valuation on the equity is really a very, I think, important point. So, what's your take on that?
I think that's right. And I think that, the valuation obviously can have a significant impact on the equity. And part of that is how you're communicating the value to your employee population. And often for companies where the valuation is headed down, they really find themselves in a pickle because, right, the equity doesn't have the value that it did. And now you're having to take something that is perceived to have less value and give more of it, right, in order to folks to feel like they're being compensated properly.
Yeah, let's look at this. I think it's important, as we discussed when we were preemptive on this call about how important it is to get your house in order and to keep it very simple. So there are many ways to be looking at private company compensation. And I'm going to backtrack. The number one way that I think at Thelander to look at compensation is by your total financing raised to date. And it's sort of laughable today that 200 million plus is the biggest category we're showing because we know that private companies are raising so much more capital on the private markets. And as they head towards an IPO potentially or liquidity, it's just an inordinate amount of money. And that the fundraising is still happening, but if fewer companies are getting the bulk of the money. And that is a whole different wheelhouse than series of financing because some people's Series A can be $100 million or Series B versus, years ago they were 25 to $50 million, right? I mean, I'm sure you're seeing that, Allie.
For sure. And it's interesting too. So what will be interesting to see is actually the SEC is very focused on all of the the capital markets and wanting to encourage companies to go public sooner. And I read an article a couple of weeks ago that the average company now that is going public is around Series F, G, like pretty far into the alphabet. And 15 years ago, it was the equivalent of like a Series B or Series C. And so really the SEC is looking for ways to encourage companies, effectively facilitate, I should say, companies going public much earlier in the process so that they have access to the public markets.
Yeah, but I think it really plays into what we're discussing today is that it's very important to get your mix of cash and equity right because
Yes.
it is a long road. There's got to be a lot of dilution. So here's the Series F or later, but we track right away the survey participation. I'll get into that. So post money evaluation, again, it covers every possible, and these can be changing on a daily basis because of depending on what where your company is valued in the market, and that can change depending on a report of where the business is headed and whether you're raising more capital and revenue. Almost half the companies have no revenue, which I think is very reflective of what's going on in the private markets. Companies in our survey are located about 90%, 87% within the United States and across the country. Location really can be of relevance depending on the job in the company, but it really is not consistent for every company and every job. It depends. And within Europe, you can see that we're also really covering the UK is a big area for us, and we're seeing other growth in Germany and in Switzerland with a lot of life science companies, and we have comp data for all of that. We also cover jobs all the way, which I think is very important, from CEO down through these staff level director, staff level roles. And the one pitch I'm going to put in, because I really have to, is that we want you to participate in the Thelander survey. It's a give to get model. Every job that you give us comp data for, you will get back on the platform for a year for no charge. So it's really important to trial the platform because we want you to have this data. So I'm going to actually jump from this for a second, Allie, because I think in terms of our, I want to move through the slide and see some information on what happens with equity over time, because that's really, I think, the name of the game right now in terms of looking at how the compensation is. Okay, I'll do this here one second. How the compensation is changing as you raise more money, I think is really relevant to everybody here. So hang on one second. Full screen. Okay, so here is some CEO compensation data looking by the total amount of financing and what's happening with dilution. So maybe if you could give us some context for if a company was raising this kind of money, where would you advise them to set up their compensation, and how is the equity piece planning for what's going to happen with this dilution? You can see obviously going from 13.5% down to a very stable market of 5 or 4.5% in the median. This is for life science companies.
Right. I guess, the point that you've made, and I know we talk about this often, Jody, is the importance of getting it right at the front end. And there will be dilution over time. The other thing, to keep in mind when you're granting options, and I've mentioned this in the context of a company with a stock price that is falling, but if you have a stock price that is rising, similarly, granting an option, it will have a higher exercise price as well. So you get more economic benefit the earlier you can nail this down. And right, the grant, as you can see from the numbers that you had, like the upfront grant that gets diluted over time, right? Standard issue founder gets their grant, it gets diluted over time.
Yeah, this is the founder
And
here is the
yeah, and it's right,
36.5%.
it's from there a stable number at the end. It doesn't mean you start at the end and that's your number, but understanding that it will get diluted over time.
Yeah, and you have to plan for that. And then here's the
Yes.
non-founder equity. So this is the person coming in, obviously not as high as the founder, but gets pretty darn close towards the end, or as
Yeah.
you're raising more capital, that's the 130 to 150. And the total cash, just for this sake of this discussion, can be a mix of base pay and a bonus that was paid out, or it could just be base pay. It really depends. And here's data for life sciences, US only. And you can see that the total equity as a founder starts even higher. And this is at the 75th percentile. But the reality is that it's very stable on the equity. And then the total founder equity is also very stable. So you've really got to plan for this because I think the piece that we've seen, and here's a little more data. Here's a CEO, and this is median year over year by valuation. So maybe talk to us about the valuation piece a little bit more, because the interesting thing is you can see that the non-founder equity is really consistent anyhow, and this is from 22 to 26.
Right. And I think that that's, not surprising to see that the non-founder equity is a stable number. It is a little surprising to me that is that stable and consistent, but not surprising to see that the total founder number as well. Again, not surprising there to see that it's sort of up on, upswing, now a downswing, and then 25, 26 stable as well, around 10%. Um, and I imagine, that what we'll start seeing too, like what we'll see for next year, I'm guessing probably stable.
Yeah, I would agree with you. Let's talk a little bit about different types of equity awards. I think it's really important that companies understand about the sort of the simplicity of that. Let me move into, sorry, I'm having it because I'm not, because I'm on the road, I do not have two screens, and that is why
Hmm.
it's moving around is not as streamlined as it could be. Okay, so here are the types of equity awards that
Yeah.
companies currently grant. So if I'm a client, I come to you and I'm saying, listen, we raised money. Now we know we're got have some runway here. We also know it's going to be a while until we raise more money again. Talk to us about the different levers here and how to put them into use.
Yes, and I think that for most companies, we start at the right with a founder award, which is often in the form of restricted stock, and that's typically your first type of award out the door. You right had a session, Jody, I think it was last month, on QSBS and the importance of that tax benefit, assuming that the company is eligible. But typically for founders, you start with restricted stock awards. From there, and the restricted stock awards might even, like, they could either be an outright grant. That's what you typically see when the company is formed, or the grant of an option. I'll get into the non-qualified and incentive stock option in just a second, but the grant of an option that is early exercisable, meaning that that option can be granted or exercised prior to the date that it's vested, which once that award is exercised, it results in restricted stock. So folks that have restricted stock can get it in one of two ways. They either buy the stock through the exercise of an option, early exercise, or that stock is issued outright. And so we start with restricted stock from the life cycle of the company. From there, you move into options, whether they're incentive stock options or non-qualified stock options. I spend a fair amount of my time talking about incentive stock options and how they are qualified from a tax perspective. I think the reality is that the vast majority of folks who receive incentive stock options never satisfy the holding period to actually get the tax benefits.
What does
So
that mean?
keep in mind, what's that?
What does that mean that they never give us an example?
So in order to actually get the beneficial tax treatment from an incentive stock option, you've got to hold the stock 2 years from the date of grant and a year from the date of exercise. And so for most folks who are holding an option, if they continue to provide services to the company, they'll often never even exercise the option because they don't have to come out of pocket and make an investment in the stock. They can have the free ride on the upside. One of the things to keep in mind, and I think that really the most significant difference between a non-qualified stock option and an incentive stock option is that on exercise of an incentive stock option, there is no income tax withholding obligation on the part of the company. So the individual exercising the option doesn't have to come up with the extra cash to cover the tax withholding, whereas they do for a non-qualified stock option. But importantly, for that same individual, that spread amount is included as an item of adjustment for alternative minimum tax purposes.
Yeah,
And so
AMT.
for the individual, the option holder who's exercising, they're still going to have to pay the tax. It's just a matter of timing. The company, of course, doesn't have the obligation to withhold and report the income. It can help facilitate the exercise of an option, but it isn't a free pass entirely.
Yeah. Let's talk about the vesting with all the equity. So it's usually
Yeah.
a time-based vesting, 4 years with a 1 year cliff. And are you
Yeah.
seeing changes to this anymore?
Uh, yes, is the answer to that. And it's as you can imagine, a hot button of all sorts because, right, I think however long your survey has been around, it's probably been, right, 4 years.
Yeah, 25 years we've been doing this survey.
And I'm not sure that it's changed. I feel like it's been 4 years is sort of the standard, right,
Yeah.
for vesting.
Yes, 4 years
Um,
for the vesting. We do hear about some changes now going on, and I've had
yeah,
let me move this back one. We have, and funny, this is a question I've been asked from reporters
yeah,
all the time is that how long is the vesting period? We are seeing a little bit on the
yeah.
3 years because I think with some of these AI companies, they have decided to, in order to get talent, they have tried to pull every trick, trick in the book to
Yep.
be able to offer something that's better. And so the 3 year vesting is a little bit sexier than 4 years,
And I also think that for other companies where might have a more volatile stock price,
right?
it can be better to have that shorter period so that you have an opportunity to reassess and resize the award. So you don't have, right, if you feel like your current stock price, your current 409A is too low, maybe you don't want to give such a large grant and you want to reduce the size of the grant, reduce the corresponding vesting period, and then revisit.
Does the valuation or the stage of the company influence the choice of the award type? I mean, you mentioned that earlier on you use restricted stock.
Yeah.
That's what sort of a founder starts with. They get granted that outright. And so maybe shed a little expertise on this.
So this is also an area that is from my perspective, it's all interesting. That's why I do this. But for on this
That's why you're
question,
on, Allie, because just like I love the numbers and I can talk about this all day long, and I listen to you and I feel like I need to really listen and I want you to
uh,
talk slowly because I can't understand it. And for you, I know you just think about this in your sleep.
yes, true. So historically, it was pretty commonplace. The playbook was you grant, and this is for technology company, you would grant, and as well for life sciences company at the founder stage, restricted stock options that can be early exercised. You move from there to options. As you become a late stage private company for life sciences companies and tech companies, there's a fork in the road because tech companies will start to grant RSUs in life sciences. If it's life sciences, health tech, biotech, whatever we're calling that, that space is tough on RSUs because of the tax withholding piece of it. And once a company is public, the ability to sell shares to raise cash to cover the income tax becomes very complicated. Not to say that it's not doable, but I think less common for pre-commercial biotech companies life sciences companies to be granting RSUs. But for the technology companies, the standard playbook was 18 to 24 months out from an IPO. You shift to RSUs, any number of reasons, including controlling dilution, exercise price is too high, all of those things. And it also became a signal that the company was getting close in time to an IPO. So I think really used as a recruiting tool and letting folks know, hey, we're getting close.
Right.
What has emerged, and I find very interesting, is that there has been a bit of a shift away from just fully jumping into the deep end of the pool with RSUs to moving to a mix of both options and RSUs. And one of the significant reasons for that is we mentioned at the outset the delay and longer runway to IPO for companies. If you grant an option and someone is holding an option, you have the ability to participate in a secondary transaction and get liquidity ahead of an IPO, or ahead of an IPO, ahead of an M&A transaction in a way that is less feasible with an RSU.
Yeah. So it doesn't matter, it really sounds like it does depend, but it really, it is on a case by case basis, and it depends
Yes,
where your company is. This is
for
an
sure.
interesting piece about talking with the option pool, right? So this is the total percentage of fully diluted ownership founders by post-money valuation for the median and the 75th percentile. And we can see that this is the only for the founders piece, and it really depends on how many founders there are. But looking in the whole component of the option pool, here we have it here, is the by total financing. And obviously what you're seeing here, which is clear, is the dilution. But the employee pool is staying pretty consistent. And do you have thoughts on this about the bump up as you're seeing more equity going into the option pool as a company raises more financing? You obviously know the founders are going to get diluted.
Right. And I think on the employee front, that those numbers I'm surprised again that there's 10 and 10 so consistently over there. But I think that what you also overlay on this is that as companies raise more money, they're often also increasing their headcount.
Yeah.
Right. And so it would make sense that that number continues to rise as the founder number continues to
Well,
decrease.
that also probably includes, and this is where it's good to discuss this, is it also includes data for that's being reserved for the future option plan, granted annually in refresh, and also granted in new hire grants. That theoretically should be part of that 10 to 15%, right?
Yes.
Right. Or could it ever be in addition to that you have to add more? I guess if you're at the lower end.
For sure, and it's not uncommon in connection with financing and raising money for the pool to be refreshed, for additional shares to be added. But and I know, Jody, that you and I have spent a lot of time talking about this over the past few years. The days of we'll call it sort of 2020, 2021, where it was like grant as much as you want and like the world is your oyster. Folks are very focused on the dilution, how much is going out the door, and really looking at the numbers.
Well, because, okay, so here's the piece on the other buckets, right? Reserved for future
Yeah.
option plan,
Mm-hmm.
granted annually, and refresh grants. And let's face it, you're not refreshing everybody. You've got to really look at the key employees. And like you said, ideally you got it right in the first place because you're not making
Yep.
up for mistakes. You're just making sure that the people who you want engaged are engaged, because you've got to also have for new hires. But if you back into this, like with a late stage company who's raised, it really doesn't change much from 90 million plus or whether it's 500 million plus. This happens that the founders have been diluted, the employee pool is holding steady around 15%, and the investors own the lion's share of a company.
Yeah. And
And
I think one of the dynamics as well that I have seen, and all the more important to get it right at the front so that you're not constantly trying to play catch up,
right,
is starting from the right place, sort of like two boats leaving a harbor, right? If one is slightly off course, they look like they're headed in the same direction, but when you get out to the horizon, they're very far apart. And the same thing is true of the equity comp, being
right.
off a little bit in the start over time, that just is magnified. And there's a lot of sensitivity to, I've seen investors, board members, directors, they start to lose patience when there's a feeling that you keep coming back to the well.
Right. Well, that's obviously very important as you're planning for your board discussions. I'm going to share a little bit of data, some CFO comp, because I know we have some
Yep.
CFOs on as well that really speaks to this. So here is some CFO data that shows what's going on in the year over year which comes from our comp planning tool at Thelander, and talks about what's happened from 22 to 23, 24 to 25. You can look how it's crazy how stable. So the reality is that if you've made a mistake or you didn't do it right, it's because you didn't take the time to plan. Because as you know, I think the theme that we've had on this conversation is that it's very simple. This is equity 101. And whether you're looking at the option pool and where the founders are, and then knowing that the investors are going to own more, what type of equity to grant, and then the amounts as it breaks down further in a company, it's not rocket science. And the numbers are surprisingly, as you said, shockingly stable.
Yeah.
And so
Agree with
this,
all of that. Yeah.
yeah,
And I think one other thing, Jody, you've already mentioned a few times, the importance of keeping it simple. Um, it's, I can't emphasize enough, there is often a tendency for folks to want to get into conversation about performance-based awards, and there's plenty of time for that in the future. And focus on what matters, building the company and growing and the success of the company, and time-based vesting.
yeah, 4 year vesting, 1 year cliff. And then what about one area just to ask before we for looking forward, what about the time for when you're going to leave a company? How long can you hold on to your equity once you go? How much, like, is it still 3 months?
Predominantly, yes.
Yeah. Okay, well, in respect for everybody's time, we've got 4 minutes left. What are you seeing in your practice now with M&A and seeing what companies have done right and what's on the horizon here, and where are companies getting into M&A transactions? Where are you seeing that a deal is being held up?
So I think that one of the other pieces, in addition to keeping it simple, get it right. I deal with a lot of, I'll just describe it as cleanup in the M&A context, where company thought they granted an equity award, but they didn't grant an equity
The
award. Thought they
documentation
had,
is really important.
yes, the documentation, and appreciate as well the desire to keep your legal spend down. It is critical to get that right the first time, and then you'll have right the sample consent. You can use it again and again, but make sure that you have somebody other than maybe Chat GPT, or take your pick of AI. Um, they're not experts yet. I'm sure they will be at some point, but really important to get that right, because it can cause a lot of chaos and static in the deal context that's unnecessary. The other piece to keep in mind too is that a strategy of reducing cash comp and just keeping it super low can also, it's not necessarily problematic, but it can have tax implications once you get to, if your liquidity event is a change in control, there will be, there's the 280G of the tax code that will look at historical compensation, and then you assess whether someone has gotten a parachute payment or not. So going the route of we'll keep cash comp low can have implications at the time of an M&A transaction.
Well, now that we're seeing that it's taking such a long time for companies to raise capital, and that it's taking such a long time for liquidity, that the sort of the go-go.com days when companies would give people a lot of equity and very little cash, and that the time in which that would have to hit some kind of balance, it's really the cost of doing that is very hard on a company. And I mean, we actually here at Thelander, in addition to our survey and then people subscribing and having access, do a lot of work on pay plans. And it's actually a product now that we've, distilled down from what used to be only consulting, because we see that young companies do need to put in pay plans for their science people, the technical people, the engineers, because you do make one-off decisions for the executives, because those are the people who are getting the lot of cash and equity. But at these more mid-level and junior positions, it's very easy to figure out the 25th, 50th percentile, 75th percentile for a mix of cash and equity, and to make sure you get it right, because that's infrastructure is really important. And it doesn't have to be complicated. I mean, we've taken it into a very, easy, simple component from like what public companies do, adjusted for private companies, because it's so much better to get it right from the start. I think that's sort of our mantra here, that there's no reason to not plan for what you know is going to be dilution, that you know you're going to need to raise money, and a lot of it on the private markets before you go public or have a transaction. And mistakes are going to, haunt you, and you're going to have to close that gap sooner rather than later. Great. Well, I am going to put in one more plug for the survey because we are like all about participation on our on Thelander Flywheel. We know that all roads lead back to the data to help you make good decisions. And Allie, thank you so much for joining us. Cooley is a wonderful partner. Your expertise is always highly valued. We had highway robbery getting you for half an hour based on your hourly billing, so we appreciate that. We'll send out a recording, and if you have any questions, we look forward to hearing from you. So thank you.
Great. Thank you. And thank you for having me.
Yeah.